Thank you everyone for joining this morning. I recognize that we are in many different places in Canada and perhaps the US as well. But before we get started, I just want to acknowledge the land that we sit on. I would like to acknowledge the traditional territories of the people of Treaty 7 region in southern Alberta, which includes the Blackfoot Confederacy, comprising of the Siksika, Piikani, and Kainai First Nations, as well as the Tsuut'ina First Nation and the Stoney Nakoda, including the Chiniki, Bearspaw, and Wesley First Nations. The city of Calgary is also home to the Métis Nation of Alberta Region 3. So the city of Calgary is where I'm sitting today. For those of you who are new to this, I just want to provide a little bit of background as to what the intent and purpose of these sessions are. Essentially, we started off with a plan to increase investor participation in the life sciences industry, catered primarily towards Alberta investors who may not have necessarily dabbled in that space, but we opened it up to any investor who would be interested in diversifying their portfolio and investing in life sciences. Initially, it was supposed to be an in-person event. Because COVID hit, we decided to turn it into webinar formats. And I think at every webinar we've had so far, I said, this is going to be the last webinar before we switch it over to an in-person day-long conference. I don't think I'm going to say that this time, just because I don't want to eat my words for the fourth time in a row. But ultimately, one day we hope to have an in-person webinar where we'll dive into some of these topics that we talked about in a lot more detail and be able to also provide a networking forum for investors across Canada. We've had 3 sessions so far. The first session really focused on transitioning into the life sciences space. So if you're a non-traditional life science investor, what does it mean? What are the hot areas to invest in? What are some things you should be looking out for? Session 2 looked at kind of experiences and lessons learned from investors who have been investing in the space for a while, things to look out for, inflection points, areas to exit. And then session 3 focused on due diligence. So if you're going to make an investment in this space, there's always a standard due diligence you make with any investment, but what specifics are there for life sciences companies and what should you be evaluating? So I sent the links out to those sessions in the original invite email, but I'll send them out again in my follow-up email. Just as a reminder, if you have any questions throughout the sessions, send any of the panelists or myself a message via the Q&A link, and then we'll put that message onto the questions that our host, Arden, will ask the panelist. So with that, I would like to introduce our host. So Arden is an investment manager and Yaletown partner and manages the Accelerate Funds 2 and 3. He's had over 15 years of private and public sector investment management experience. He works with portfolio companies to support their performance and is highly active in the Alberta technology startup community. He's got an investment career that spans commercial real estate, public equities. His career as an investment professional in multiple asset classes gives him a broad perspective on capital markets and various ways to find value. So I think he'll be an excellent host for today's session. And with that, I'll pass it off to Arden.
Thank you very much. Before I kind of get into introductions with our esteemed panelists here, just to reiterate, our goal today here really is to focus on early stage investments in the life and health sciences sector, and really illustrate how investors can get off the sidelines and find early stage opportunities. Later stage funding in this space is definitely out there. A shout out to a friend and colleague of mine, Jamie Lucien, who I see is out there. He has a group who, has connections to later stage funding in this space. But as he's mentioned to me before, the biggest issue here is the liftoff phase that we're talking about today. And so I think today's talk is really relevant and extremely important in the landscape of life sciences investing in the startup community. So what I'd like to do is kind of hand over the introductions to each one of the panelists in kind of in the order that we're going to be hearing from them. And we'll start off with Derrick Hunter. I think a couple people here might know of him or have heard of his name, but I'll let him kind of introduce himself and what he does.
Okay, hey, thanks, Arden. So I'm Derrick. I'm the CEO of Bluesky Equities Limited here in Calgary. We're an absolute return-focused, unconstrained, privately owned investment management company. What that means is we invest in a wide variety of asset classes, and we don't measure ourselves next to an index. We look to make money at all times, every year, in all markets, regardless of conditions. And one of the things that we do and have done in a pretty structured way, I guess, for about 9 years, is to invest in early stage tech companies. So we've developed a portfolio since September 2012. We've invested in, I think we're up to 87 early stage tech companies, and we have a process that we use. I wouldn't say historically we haven't done a lot in the med tech space, but in the last couple of years we've kind of drifted into it. So I had my analyst pull down the numbers. We've made 9 investments in the medical space over the last couple of years. You know, Arden, do you want me to talk a bit about our strategy and that sort of thing at this point, or is it just a, sorry, you're muted.
Yes, I was just testing everybody. No, no, we can save that for once we get into the panel section.
Okay.
No, that's great. Thank you.
Okay.
All right. And so, you know, again, thank you very much, Derrick. You know, we've got the one of the kind of coming in from the family office and investor side of things. Next, I'd like to hand it over to Crystal Phillips.
Thanks, Arden. So great to be here. Before my role at Thin Air Labs, which is where I'm at right now, I was a competitive speed skater. Through my personal health journey, discovered some of the gaps in the healthcare system that I really wanted to fill. So I started the Branch Out Neurological Foundation, which is a charity that funded neuroscience and innovative tech and some of the unconventional approaches for neurological conditions. I was able to grow that organization thanks to a lot of philanthropy work in this province in Alberta, and fund over 100 research projects and programs in 8 universities across the country, which really gave me a lot of interesting insight and connections at the early stages of innovation in health. And then realized this other gap, which is we have so much great innovation, lots of IP, and it's stuck in the labs of universities. What can we do to get it out into the hands of entrepreneurs, or make entrepreneurs out of these scientists, to create amazing companies that can create not only great human impact, but great returns as well. So it was a very natural progression to then move on and stay on the board for the Branch Out Foundation, and then move on to Thin Air Labs and help build this ecosystem studio where we invest not only capital, but we also invest business resources and ecosystem building projects, so that we look holistically at what it takes to build not only great companies, but a great thriving ecosystem, so that it's long-term and sustainable.
Fantastic. Thanks, Crystal. And finally, over to Jaspreet Grewal.
Great, thanks, Arden, and it's a pleasure to be here. So my name is Jaspreet, and I'm based in Calgary. I am a clinician turned consultant and venture partner. I work as founder and CEO of a contract research organization and clinical consultancy focusing on the emerging biotech sector. And the work that we do connects us to early stage companies through to companies looking to complete their phase 3 clinical trials. So our exposure is to a number of different clientele along the way. I'm a big supporter of the Alberta life sciences ecosystem with my various roles, including being an expert advisor to Innovate Calgary. I'm also a board director with BioAlberta, and I also work with Calgary Economic Development in their life sciences team. So great to be here.
Great. Thank you very much. Okay, now we've kind of established who the players are around the table. I think everybody can see that all of our speakers bring a very different background to the table. And rather than, you know, asking the same question of everybody, we want to kind of dive into each person's experience and kind of relay a story to you that makes sense in terms of how you can find opportunities and deal flow in the sector. I'd like to start by talking to Derrick a little bit, because Derrick, comes from the family office background. He's a private investor, angel investor as well. So much like I imagine many of you in the audience. And so, Derrick, really, you mentioned before, right? You're a sector agnostic investor. Your family office is as such, your fund is as such, and maybe we can go a little bit more into like how does the life and health sciences fit into your investment thesis, and this some of the strategy you were mentioning beforehand.
Yeah. Okay. So as I mentioned, I mean, I sort of designed this strategy coming out of a seminar in September 2012 that one of the founders of 500 Startups, which is a US-based, Silicon Valley-based venture fund, put on. And our strategy is really about placing a lot of bets and having a portfolio approach, knowing that we can't pick winners at the very early stage where we tend to invest. We're sort of post-love money, pre-Series A investors, and so we don't typically do pre-revenue most of the time. But we have a real a process and a format that we work through, and we are sector agnostic. As I mentioned, we've done 87 seed stage tech deals over the last 9 years, up until a couple of years ago, and of those, slightly more than half are Alberta based. So we are, we definitely have a home field bias, although we are geographically and industry agnostic. But we tend to see, I think, a lot of deals in Alberta because we're here and we're known. And I guess what I would say is, for quite a while we hesitated to invest in the medical and the life sciences space, chiefly because we didn't really have the chops to really do our own due diligence, and we had no domain expertise, and we weren't really sure how to align ourselves with people that did. And so that kind of kept us out of it. That changed over the last 2 or 3 years. We've done 9 investments in the life sciences, sort of domain, health tech or med tech. We haven't done any pharmaceutical investments, but I think a couple of things drove it. One was that I've been a fellow at Creative Destruction Lab since the beginning, and there's a number of doctors in the room, and we see quite a few med tech opportunities that come through, and so the opportunity to sort of follow their lead and then kind of piggyback on their due diligence, be a bit of a lemming, I guess, has been appealing. I think the other thing, I also chair the board of the Council on Innovation and Entrepreneurial Leadership at the University of Calgary, as well as I'm an advisor to the General Health Fund at USeed. And what you come to appreciate when you spend time on those kinds of panels is, there is a lot of really high quality research being done in the life sciences, throughout Alberta, but in particular at the University of Calgary. And so I'm very much of the opinion that, if you're looking for areas where we're going to see a lot of future growth in tech and innovation in this part of the world, med tech is number one with a bullet in my mind, just because there are just so many phenomenal experts doing like cutting edge research in just sort of everything from, superbugs to early cancer detection to bone and joint to brain health to you name it, right? So, it's a very opportunity rich environment that also has tended to be under invested, I suppose. I mean, it's changing. You're seeing more external, like non-Canadian capital move into Alberta because there are good opportunities and valuations tend to be reasonable. But, so I would say, there just are a lot of really cool things happening. And so as a result, that's why we've kind of drifted into it. We don't lead rounds, so we've always tended to piggyback on somebody that we respect and that's got domain expertise. We tend to write small-ish checks the first round, so we treat our initial investment essentially as an option on the subsequent round. We like to be able to participate after we've been able to observe that the management team can execute. Then we like, the ones that are able to execute, we like to have the option to participate in a subsequent round, higher dollar check, albeit at a higher valuation, obviously. And that's sort of the bare bones of our strategy is let the winners ride, but to have lots of chips on the table. And so, as I say, we've been doing this for 9 years, and we tabulate our data just like a VC fund. And what we found is that we're a top quartile performer, even with our home field bias. because we've employed that strategy. So we've had a number of exits. We've actually had more exits than bankruptcies, which has been a surprise over that period of time so far. I mean, that can change.
Knock on wood.
I don't want to. Yeah, I don't want to. Yeah, really, with some wood. But I guess my message, Arden, if there was one message to people in the crowd that might be thinking about doing this, is that I'm fully satisfied based on our experience and our data that, first of all, I mean, by doing seed stage tech investing here, this is an uncorrelated asset class. It doesn't depend on markets going up and to the right. And if you do it in a very sort of proactive, organized manner and you build a portfolio, you can absolutely produce market-beating returns without the volatility you see in public markets, as well as producing a very positive impact from an economic development perspective, i.e. company building, job creating, and so forth. I mean, I think we've calculated that our companies, I think in 2021, collectively had $90 million, just the Alberta ones had something like $90 million in revenue, employed a couple thousand people. So it has a profound impact. But that's not why we do it. We're strictly profit seeking with this asset class, right? So I just think it's really critical that investors understand that at the front end, nobody can pick winners, right? Things can steer into the ditch on short notice, and or go through the roof, and it's just very hard to predict at the front end. So you just have to have. You don't want to put it all on one bet. You want to have a diversified portfolio, and if you're getting into an area that you don't really know a lot about, it's really important to align with some experts that can provide kind of that front end deal scrubbing that you may not be able to do yourself.
Okay, thanks for that's some great insight into your strategy and how you approach the investing world. And I mean, I want to come back really quickly to the whole lots of chips on the table. I mean, even finding 9 deals in the last year in one segment is quite a number for your average investor. Where do you find these deals? In terms of, what would you say to some of the people in the audience is where they can look for opportunities?
Well, just to explain our funnel. So those 9 were over about 2.5 years. But so I have a full-time analyst portfolio manager that only deals with this particular, not necessarily medtech, only deals with our angel portfolio. We see an average of just under 300 deals per year, of which about 80% won't fit our metrics for one reason or another. And it doesn't mean they're a bad company. It just means it doesn't work. The 300 deals come from all over the place. Some of it's through CDL, a lot of it's networks, a lot of it's cold calls. I was the angel of the year a couple of years ago, and so that led to an uptick. We're also one of the top 10 investors by number of deals in the CVCA survey year after year. So there's I think for us, it's a bit of a reputational thing. We get known, and so therefore people get referred to us. But just to explain, so we'll get about 300, just under. Typically over the last 4 years, it's about like 290 deals per year. We'll take a look. We'll reject just a little over 80% of them. The remainder will go into due diligence, and we ultimately invest in about 5%. So our hit rate is 5%. We've averaged roughly 15 investments per year for each of the last 4 years. We don't have a quota. We just invest in deals that we like. So it's not like we're trying to hit a certain number. I think that number is likely to diminish over the next couple of years, on an annual basis. And, so a 5% hit rate, I mean, you're a VC, so, that's pretty high, right? But in the context of an entrepreneur coming to me, that means we're rejecting 19 out of 20. So that's pretty low. So it kind of depends, how do you, glass half full, half empty sort of thing, right? But that's what our numbers look like. And the 500 startups model, and a number of people have talked about it. I mean, to give yourself a high probability of a positive outcome, there's a lot of analysis out there that says you've got to get a portfolio of roughly 40 companies, all things being equal. I originally set out to build a portfolio of 40. We've hit 87. I mean, we keep going. I'm not sure you necessarily need 40, but it's got to be more than 3 or 4. And as I say, so if you have a 10x, I mean, that makes up for, 9 losers, right? So, but picking which one's going to be the 10x is the trick. And it just, in my opinion, cannot be done at the very, very early stages. So we treat our initial foray as our opportunity to learn about the quality of management. And I would say that if you don't want to build that funnel, or you don't have the time or the inclination, that's when the investor should partner with somebody, within our labs or a Panache or some organization that's actually in the business of curating deal flow, selecting, doing due diligence, monitoring, all these things, right?
Right. And I mean, that's a very interesting point, and I think it's great for the audience to be able to see that even with the number of investments and the success that you've had, you didn't come into this as a quote unquote sophisticated investor in the life sciences sector, but what you did was partner with, network with, and learn from some of the other organizations out there in order to kind of get some knowledge, get some access to deal flow. And I think that's a nice way to kind of transition over to what we're going to talk about with Crystal, in terms of building those networks. I mean, Crystal has mentioned that in your intro that you kind of got into the life sciences sector through some of your own personal passions and your own involvement, and that kind of really helped you branch out. But now you're part of this organization that is an organization that others can reach out to and such. And so maybe, Crystal, if you could kind of lead us into your experience and advice on, how do you build that? How does an investor build that network so they can find deal flow and gain some sector knowledge?
Yeah, it's a great question, and it's a lot of what Derrick was talking about as well. And thankfully in Calgary, Alberta, even Canada, it's still quite small. Like, the growth capital is new for a lot of people, and there's a lot of opportunity that's just growing. So people are very curious. They want to meet with others. They're humble to a certain extent and want to learn a lot. So you pick one of those networks that you have, or one of those connections, whether it's a doctor who's your neighbor or something you read online, and you start there. It doesn't take very long to then get really connected to all of the activity that's happening. And COVID has really shone a spotlight on the healthcare sector. Of course, doing these Zoom videos and webinars has made it a lot easier to make all of those connections. So once you get started, it's kind of like you get overwhelmed with how many people are enthusiastic about sharing deal flow, reaching out about new ideas and companies. And so being able to kind of map that in your own way is really helpful, because then you start to look at not only all of the connections that you have in the life sciences sector, which is probably more than you think. You get started there, and then you start to look at how all of those connections are connected. And then we're very active at Thin Air Labs. I'm very active myself in attracting inbound, but also doing a lot of outbound work. So, doing webinars like this, sitting on panels, a lot of public speaking, meeting one-on-one with founders who have just an idea, even if it's at the early stages of innovation. We also have this services arm, Impact Services, where we work with entrepreneurs before they might be investment ready, and we help them access non-dilutive funding, or help them with go-to-market strategy, or marketing and advertising their narrative. So we use that as a really excellent source of deal flow. So regardless of whether you have an impact services program, even just volunteering to work with founders and understand what their needs are, it becomes a great source of deal flow access. It also builds your reputation and your brand. For example, at Thin Air Labs, what's really important to us is being founder friendly, because we understand that founders are the portal to our success. And the more we can support the founders, the more successful we will be. We also are built with founders within this company. James Lockery, our capital partner, founding partner, he built Wave Financial. He knows very much all of the ins and outs and the traits, and also knowing how to respect and work with them builds a reputation that founders want to work with you. And probably like Derrick, you'll start to get this inbound interest from founders, and it's sometimes feels like picking your favorite kids.
No kidding. I just want to come back to a term that you used, and that some investors might not really understand what exactly what it means. But can you elaborate a little bit on what you mean by founder friendly?
Yeah, so founder friendly really is just understanding, especially in the life sciences sector, a lot of the founders are actually academics or scientists. They come from that background, and they are keen to bring their research, bring their ideas outside of the lab. That is a personality, that is a strength that once you start to meet with them, you start to learn the nuances and some of the patterns and needs that those people have. And you start to really individualize how you work with founders, instead of just kind of putting them into some type of system and assuming what their needs are. So it's really personalizing your approach to how you work with companies. There's also a lot of entrepreneurs who have no background in life sciences, but they see a problem and they want to fix it. And so they partner with the subject matter expertise and they build companies that way. And there are still those traits and nuances about their personalities that make them crazy enough to be a founder. So there's a lot of just respect and understanding and ability to love the unlike minds approach of working with founders.
Okay, no, that's great. And it sounds to me like what's emerging here is the idea that I know in the past that the model of angel investing would have been you have your individual investors, such as some of the folks in our audience, and then you have a company, and the difficulty was them trying to connect directly with them and trying to find opportunities, and that would hold a lot of people back. But what the emerging story seems to be here, and especially I would say over the last 4 to 6 years, is that there are now intermediaries and organizations like Thin Air Labs, where the investor can plug in, get to know, and then kind of rely on their relationships and learn from them and their kind of like their experience and such. Like you said, I mean, James built a $500 million company. There's some significant experience there with entrepreneurship. And this idea that, it's a customized approach to each one, but the individual investor doesn't have to worry about that if they have a network to plug into. So I mean, specifically for Thin Air Labs, do you work with angel investors? And if so, like, how do you work with them?
It's a good question. So just like we love working with founders, we also love working with investors, and we want to create opportunities for investors to learn from and be as involved or as little as involved as they would like in this innovation sector. So for example, we'll have an angel investor invest in our fund, which we're raising right now, and we allow them to, come work at our office. Eventually, post-COVID, we'll have this space behind me buzzing with founders, entrepreneurs, investors, and we'll be, creating a lot of opportunity around the water cooler to advance and accelerate the success of the company. So we really love working with angel investors of all types. We welcome them into our fund if they don't want to, say, go out on their own and they want to learn about this stuff, and or they want an opportunity and a direct line to these innovation companies in the life sciences sector. But then also we are sector agnostic like Derrick. We just have a strong opportunity within life sciences. And when you're talking to me, you'll notice a strong bias there too.
Or absolutely. I understand you are that's where your main focus is, right?
Yeah.
And that's really encouraging to see, and, just so that the audience knows, this isn't strictly a plug for Thin Air Labs. I mean, we're very fortunate to have Crystal here. But I know that, and I'm in managing Accelerate Fund 3 and being part of this ecosystem. We're also a sector agnostic fund, and we often will look to other groups that have expertise. I mean, there's resources out there that include Platform Calgary, locally here in Calgary, obviously. Startup TNT, which is a grassroots organization that puts investors and entrepreneurs together. And they actually have a life sciences summit coming up in March. And so investors who are interested in seeing what's out there, I think they're going to have at the finale in March, I think there's going to be 5 companies pitching. I know that Platform Calgary, Nima, you said you were working on something down the road too, maybe later on this year to do an investment summit. And so there are lots of opportunities coming up for angel investors to get in there, see what's going on, network with other investors, and connect with organizations like Thin Air or Panache or Accelerate Fund to learn more about the investing side of things. So that's really encouraging. I also want to take the opportunity now to turn to some other sources of support and deal flow for investors, such as consultants. As we heard from Jaspreet, she works in this field, but in a different capacity than the rest of us who are talking here. And so, Jaspreet, maybe you could dive a little bit further into what kind of work you do in the life sciences sector, and how does that lead to identifying, actual deal opportunities?
Definitely. Thanks, Arden. So as a consultant, we typically work with early stage and even more progressive companies so that are further down their clinical pipeline. Our team is made up of clinicians, nurses, management consultants, as well as other equity analysts as well. And we are a split between a contract research organization and a life science consultancy team. And how we work with companies is, well, first of all, most companies typically come to us through word of mouth or are referred to us through their lawyers, through other consultants, or even through their investors. And what we do is, in a clinical capacity, we actually manage clinical trials. And then in a consulting capacity, what we do is we actually help to shape the pathway or the commercialization pathway for biotech companies. In some cases, when it's, for example, if we look at a very early stage startup that has identified a lead molecule, they're getting ready for a clinical trial, but they're not quite ready for Series A, we come in and we essentially prime them for what their regulatory hurdles and strategy will be like, the best jurisdiction to conduct their research. And then what we do with their financial team is actually budget out how much a clinical trial will cost, not just up to phase 1, but beyond. And as those of you who already invest in life sciences know, and more so on the pharmaceutical side, after every successful phase of research that you complete, your valuation, if it's positive that is, your valuation does tend to increase. So we look at those milestones for the team and for the investors. And what we do with investors specifically is twofold. So one, we have already worked with them. We have a very robust network in a number of different countries, which we're very fortunate to have. We go in and conduct more initial clinical due diligence for the investors, just to say what we feel is the correct pathway for that client. We also look at the team and the management if they seem to be suitable for that particular company. On the other side, it's strictly deal flow. So either we're submitting companies that we think meet the investment thesis of our partners, or if we have investors saying, I'm specifically looking for a client or a company in this space at this stage and in this sector, we then work with them in that capacity too. So that we're very fortunate that we are able to see a lot of different clients in an increasingly more broad set area of the life sciences.
Well, it's nice to hear that you not only work with companies for deal flow, but you work with investors as well. Could you, talk to us a little bit about how do you find these investors and what do those investors look like?
Certainly. So a lot of the investors that when we originally started came from our personal networks. And then over time, and similar to Crystal, with more public appearances, more speaking opportunities, we really started to gain recognition. And we also do have a positive track record of helping to invest for our clients and raise capital. So that really built the momentum for us. As I mentioned during my introduction, I work with BioAlberta, and I also work with the Canadian High Commission in Life Sciences. And through their relationships and networking as well, we've been able to increase our network, if you will. What we have created as an internal asset are almost clinical and financial maps of where all of our partners are. So our company is actually incorporated in Canada and the United Kingdom, and we do work in Australia, the US, South Africa, and Singapore as well with different clients. And so we do get access to a broad range of investors, angel investors, and other corporations that help to bring together these different kinds of groups and companies. And it allows us to network with investors as well.
Okay, so it sounds like it's a very wide variety of investors that you work with, anywhere from high net worth to family offices to funds and such, and through this early stage or phase of a company's growth. In your perspective, it sounds like you're involved in a lot of different organizations, right? Maybe we could take just a few moments here and round things out by focusing on, what other resources can investors lean on locally that you would recommend that they look into? I mean, aside from the panelists we've talked to, that have spoken here today.
I think one of the greatest assets we have here locally, specific to Calgary and Alberta, is a USEED fund. So that's through the University of Calgary and Innovate Calgary. And there's an incredible amount of companies and deal flow coming out of there. But for other investors, I feel like it gives you a stamp of approval that there's confidence that USEED's already on the cap table and that the due diligence has already been performed. And I feel like that's a really great asset that we have here specific to the life sciences in Alberta.
Great. So USEED. And I know, in terms of our fund, we have relied on their due diligence in the past as well. They do a fantastic and thorough job of summarizing stuff and digging into it, which is great. Again, that certainly helps. So even funds aren't beyond using utilizing other resources and such. So I think, before we jump into audience questions, I'd like to kind of sum up what we've talked about here and then ask one final question to the panelists. But I mean, really, the theme here seems to be, lessons learned. What I'm seeing is that, number one, you don't have to be a sophisticated investor to get into space, right? I mean, there are ways to get in there and learn, and that's through building your networks. The networks locally are there, so all the people in the audience here should know that all you really need to do is reach out. I mean, as an investor, you have to do some work, obviously, but the work doesn't necessarily mean you jump in and find a company. It means building your networks, reaching out to people and resources like Platform or like Thin Air, and going to events like Startup TNT and investing. Despite some opinions, it's a participatory sport, is what it is, right? You don't sit on the sidelines. You have to do something. It's not like the stock markets or whatever. You just push a button and you make an investment. You really got to actively go out there. But it sounds like the rewards are there, right? It's certainly worth it, as Derrick had mentioned earlier, and the fact that there is a lot of support out there throughout the different later stages of a company's growth. And if you invest in an early stage startup and it does well, you're not necessarily just stranded, in terms of the support that's out there. There's a whole infrastructure here waiting for companies to grow and get to that stage where they go to a clinical trial and they are able to exit. And you can actually, this is probably a conversation for another day, but you can actually get your money out at that stage. And so you don't have to wait the 10, 15, 20 years till something gets all the way to market. There are opportunities to get out of a lot of life sciences companies much earlier than people would think. Now, before we get into questions from the audience, I'd just like to round things off by asking, what do you see as a trend or strength, right, for the life and health sciences in Alberta coming up over the next decade? Private investment in particular is a long-term game. And I'll leave it open to anybody who wants to answer that first. Maybe go ahead, and whoever unmutes first will be like Jeopardy.
I'll take that challenge. I think a trend that's really exciting in the life sciences sector. I talked about COVID kind of putting a spotlight on the healthcare sector, which is one of the silver linings we can take. The other thing is we've wanted to diversify the economy and look at new economic drivers in the province of Alberta for a long time. That has given people confidence to just look at other sectors. And we have so much groundwork that's already being done and already has been done for decades in the universities across the country. So being able to look at that, but then also from the inside, academics and scientists want to be able to and have the confidence to take that next step to move their research outside of the lab. So they're no longer only incentivized to climb a hierarchy ladder within academia. They're incentivized to make real impact with all of that research that they've been dedicating their lives to. So I'm seeing a trend in just confidence in growing the health sector from all angles.
Yeah, I think I'll jump in after that. If we look even just purely at the government of Alberta and the recent investments they've made. So $80 million into vaccine technology. And that's a significant amount of money and dollars going into 3 companies that have already shown a significant amount of progress, even with their clinical trials. And what that does, and this is also to Derrick's point earlier, that when we have this investment that supports these larger companies, you also do support a larger incoming workforce, which I think is a really positive trend. And it should give investors a bit of confidence to say that, these are really moving forward as companies and they're Alberta based, which is, I think, fantastic. Additionally, that cross-section between tech and life sciences, with groups like Plug and Play opening up a large accelerator and more private companies setting up tech offices here, that intersection between healthcare and tech, so med tech, is another burgeoning area. And of course, leveraging artificial intelligence and machine learning. Alberta is certainly known for that, and I think it will continue to be a positive trend moving forward.
Fantastic. Derrick, any other observations to add? Like, why are you bullish on the life sciences and med tech sector?
Well, it's hard to really add much to what Crystal and Jaspreet said. I agree with their comments. I think Jaspreet's comment about AI and ML is really valid. We've got several investments in AI or ML related companies. I think what I see happening is, there's a lot of reasons to build your business in Alberta, and it's not empty office space in downtown Calgary, right? It's cost of living, quality of life, competence of the workforce, demographics. I think the thing that is in front of us is we've got to build an economy where energy is one important industry among many, and there's just been so much research into life sciences undertaken here over the last few decades, and a lot of it's been driven by philanthropy, right? But that is what is now creating these incredible opportunities, and that's kind of a uniquely Albertan thing. We've had so many great philanthropists that have decided that there was an area of particular interest, and they threw considerable resources behind it, often matched by the government. So, I think the trend is towards more commercialization of the lab research that's been done.
So it sounds like the bottom line here is there's never been a better time to invest in early stage life sciences companies and tech in general. And that's very encouraging to hear. That means we all have work to keep doing down the road. We had a couple of audience questions, and I think in the interest of time, maybe we'll limit it to one person answering the questions, whoever feels they want to take it on. The first one is, how long after connecting with a network or consultant or organizations like Thin Air Labs does it take to actually get the deal done? Is it a quick and easy thing? Anybody have a general, or is it just it depends?
Yeah, no, one size doesn't fit all. So, I can only speak for our experience, but it really depends, right? But we don't lead deals, and so we're a pretty quick no, and most of the time we're a pretty quick yes as well. So I would say the median is from sort of introduction to decision is probably a small number of weeks for us. But if there's something that just doesn't fit, and the biggest reason to say no, honestly, would be valuation. So if somebody comes to us with a ridiculous valuation, we'll just say no and we'll move on. And I think that here's the thing, right? Like, we've literally seen hundreds and hundreds. We see hundreds every year. So we've got a pretty good, it's more art than science, but we've got a pretty good sense of what we believe anyway is fair value for a private company. And so we've got this basis of comparison that the founder just doesn't have, right? The founder has really one. They've got their company. So it's a bit of an unfair fight, but right. But I would say a good deal, reasonably priced, good terms, skin in the game, good founders, good market potential. For us, we'd probably get to a yes within 4 weeks typically.
And I think it'd be great to hear from Crystal and Jaspreet as well. I just realized that I misread the timing here. I thought we had 5 minutes left, but we have 15. So if you two want to weigh in on your perspective on that question, I'd be happy to.
Sure. I can go from my perspective. Maybe one of the things we didn't talk about is private lenders. So actually, Arden, you talked about it earlier, like that liftoff phase, how they're not quite ready for, angel, but they just need a bit of operational capital. And we do find even with that, with some of our early stage companies, we're probably looking at about 4 to 6 weeks of due diligence from an investor standpoint to go in and really take a look at the terms, look at the company. But then as we move forward, so we have another company we're preparing for Series A, and we're right now going through diligence with an investor, and we're up to about week 3 right now. So I think to Derrick's point, everyone's a little bit different, but it depends where you are in the spectrum. And I think also the risk involved, so the complexity of the project and the opportunity. So medtech is very different than investing in a biologic. So unfortunately, it's not a very clear answer for me either, but it's a scale. You just have to look at what you are investing in, what area, phase, and the risk involved.
Okay.
Yeah, I agree with Derrick. It's not one size fits all. We're a 10-year fund. We want to deploy our capital within the first 3 to 4 years into about 40 companies, mostly from Alberta and the prairies. We ideally would like to say quick yeses and quick nos, again, as out of respect for the founder so that they can continue on their journey. We hope to lead rounds if that's in the best interest for the founder and the company, but we also want to help that founder and the company close that round. So if we're not taking a whole round, to introduce them to other angels or other investors so that they can move on from the fundraising mode and get quickly into building their company.
Okay. We've got a number of questions now pouring in the original too. So I think, to get through these, we'll go back to the one person who feels like they can answer this one. So next one's from Neil. How do you view regulatory risk, an extra layer of complexity compared to many other industries in making investment decisions?
In terms of clinical regulatory or financial regulatory, what kind of regulatory are we talking about here?
That's a good question, Neil. And I'm assuming this is more in terms of clinical.
Okay.
Neil, are you out there? Can you?
Just responded, yeah.
Okay, yeah. There.
So I guess I can take a shot at this one if that's fine. So yeah, certainly when we're looking at different kinds of, again, it comes down to what area of healthcare you are in. So if you're looking at med tech, or if you're looking at a biologic, if you're looking at an oncology drug, it depends on the population you're addressing, the competitive landscape, what stage, so what country you're also going into, so who are you filing with? These all kind of play to regulatory. I think at the very minimum, an investor wants to see a regulatory strategy that the filing system, what you need to do to get to that point. And our company works a fair amount in the emerging psychedelics, and we've been working in cannabis for a long time. And those layers of regulatory are very different. So I think with having domain expertise is critical when it comes to clinical regulatory, to really understand, is the team or the management team assembled prepared? Have they hired a regulatory consultant to do this for them? Do they have their pathway figured out? And do they have the time and the money set aside to accomplish this? Because again, your timelines are going to be dictated by the reviewer of who you submit to. So you can't say that we're going to be done regulatory and have our filings done in 3 months. You're looking closer to 9 months sometimes. So I think it has to line up, and seeking domain expertise and understanding what kind of area you're playing in is going to be very critical here. And investors should really seek that out when they're dealing in the life sciences.
And it's, as an investor, point of view, it really comes down, that's another risk to manage. So answering the question of how have you managed that risk? So if there's regulatory risk and there's no consultant on board and there's no line of sight on how to overcome that, that's a huge risk. But if the company has somebody on board and they have the experts and they know all the steps, or they have someone on the team that's been there and done it, that's another way. It's like, again, it's another risk to be managed.
Exactly.
Okay, moving on here. We've got about a half a dozen questions in total from Dave. Can you talk about how much opportunity there is in this sector for further collaboration by all investors and ecosystem partners, thinking of making this easier to navigate from the founder's perspective? And I'm wondering, Dave, is the question you're asking like where to start? Like where do you go? Just kind of, and if that is the case, that maybe Crystal, do you have some insight into that?
Yeah, so part of my role is I triage founders. So they come to Thin Air Labs, and often they're at that starting point. They don't really know even if they're ready to start to raise capital. And it's really just being transparent about our ecosystem and tapping them into these connections, and then figuring out which ones have the most potential and are most fitting for them. The thing is you can go down a rabbit hole of connections and meetings. And so that can be a little bit daunting for a founder. And there's, you know, like I said before, once you meet one person and you see all of the connections, you see this whole ecosystem of people that you can meet with. So it's nice to have advisors and mentors to help guide you and make sure that you're meeting with the most appropriate connections out there so that you're using your time wisely.
All right. I mean, hopefully, and again, you know, we just got time to kind of go over these questions at a high level. I think, you know, if there's deeper questions, or, you know, you want any of the panelists, I think the panelists are fairly approachable. And so there might be an opportunity later and it's a good way to build your network, is to come in with those questions. So I just want to be mindful of the time here, as we've got about 8 minutes left. Jahangir's asking, and hello Jahangir, good to see you, sort of, virtually. As panelists today come from diverse backgrounds, he's interested in your thoughts on why now is a good time for incorporating technology in medicine. And I'm wondering if maybe Jaspreet, you know, this seems to be kind of more in your wheelhouse. Why do you see now as a great time for tech and medicine to be combining?
Well, I hate to use COVID as a reason again, but COVID really pushed that decentralized virtual model forward. We've been trying to incorporate more virtual hybridization of medicine in clinics and even visits for a very long time. But the amount of momentum and capital into the field has really pushed that forward. And not just in like medicine in general, but even for clinical trials. Like when we started our CRO, we launched just before the pandemic, and we actually designed our company to be decentralized, meaning we don't have a physical location. We can project manage clinical trials all around the world just based on the software and the tools that we use. And it's very easily done. And I think that in research, we've been doing it for a little while, and in healthcare, so visits, trying to do them virtually, it's been happening. But now we're getting to the point where there's, I feel, a lot more momentum and understanding and more adoption. So I've worked with physicians that are not keen on adopting technology, but this year, in the last 2 years rather, you're almost forced to. And once it becomes sort of second nature, you're always looking for the next thing. How can I continue to improve efficiency, maintain patient safety and outcomes, and privacy? So I think it's a great opportunity. COVID, I think, was the catalyst to really get this going for us, in my opinion.
Arden, could I just add something? So, you know, I mean, it's a good question from Jahangir, but so the way I look at it is, if you look back over the last 10 or 20 years, I mean, all net new jobs in the developed world have come from startup companies, right? I mean, this is established. And when you look at high growth companies, they're overwhelmingly technology enabled. So every industry is becoming a tech industry, right? There's no tech industry anymore. Every industry is one. And so, you know, it would be unrealistic to assume that health or life sciences would be any different. And I think it's just a natural evolution of the disruptive age that we live in. And I think it's a trend that's not going away. And particularly when, you know, Jaspreet talked about AI, I mean, yeah, there's just, it's just inevitable. And that's where, you know, in some applications, we're kind of at the thin edge of the wedge, and that's where opportunity lies, right? In every age of disruption, there's opportunity. You've got to just train yourself to identify it.
Right. Awesome. With only a few minutes left, I think what we're going to have to do is kind of save these questions for a direct contact. Me and Jamie, you and I can talk about an investor timeline, and we'll make some introduction to some of the panelists. Aleem was asking about, being in real estate, wanting to diversify, minimum amount of capital you should set aside to play in the sector. I mean, that is noting that in early stage investments, like in the first round, this is, I mean, it's not a massive amount. You don't have to put aside millions, but that is, something that you could probably talk to someone like Derrick or Crystal about, or even myself, right, in terms of how do you build a portfolio. There's a lot more questions that need to be answered versus beyond just how much do you set aside. So this really is about portfolio management. And again, that's you know, a discussion to get in depth later. Meg, you know, Startup TNT has been mentioned, a lot of networking opportunities, including Start Alberta and more. I mean, Start Alberta is itself a portal to look for deals. Startup TNT is an actual meetup in person. It's probably a good place as any to start. I would just say go to all of them, right? All the things. That's the best way. But if you have to start anything where you're going to meet other people who are doing what you want to do, all right, and that you can learn from them. That's probably the guide. And unfortunately, you know, I think the rest of the questions here are going to have to be asked. And maybe what you can do is, you know, get our emails through, I don't know, what's the best way to pass on, or maybe Nima, you can, you know, forward stuff to us as necessary. But I do want to, I mean, and obviously it's great to see the enthusiastic responses and questions from the crowd. Obviously there's interest in the sector, but I wanted to kind of end this on that note, and you know, allow Nima to kind of close things off. And I wanted to thank all the panelists for their time, and everybody here for spending an hour with us learning about, you know, how do you find deal flow and getting involved. I think there's a lot of great opportunities, it sounds like. And, you know, really, I'm not just sounds like, I can see that as an investor myself. And like we were saying earlier, there's never been a better time to invest. So thank you, everybody. And I'll head back over to Nima.
Absolutely. Thank you, Arden. Absolutely. Any questions you might have, every one of you should have my email address, since I was the one who sent out the original invites. So please feel free to email me and I'll send it to the relevant panelists as necessary. I just want to close off by first thanking the panelists and our moderators. So really appreciate this really great set of different panelists, all coming from different investment backgrounds, who were able to kind of give us a diverse set of opinions to a lot of these answers. Thank you as well, Arden, for moderating the whole thing. I think it was really well done. I also want to thank the committee that helps make all of these investor education webinars possible. There is some overlap between the committee and the panelists. So Venn Consulting, Jaspreet, Crystal Phillips from Thin Air Labs, Chantel from Innovate Calgary, and Rahim Nathu from Fluid Biotech. You know, without their efforts and help, this certainly wouldn't be possible. I will follow this session up with an email to the people who attended with a copy of the recording of this, so you can reference it in case you want to go back and look at it again. I'll also send out a survey. You can just reply via email. I'll gather everything. You know, if you have more questions, or if you like to see any other topics in the future that we would like to explore, we're happy to put sessions around that. As well, to gauge your interest in us hosting a kind of a pitch session from companies that either Thin Air Labs or Bluesky Equities or UC Health has invested in. So we can have a curated set of companies that have these stamps of approvals, as Jaspreet said, to put in front of you. Then you can gauge whether you're actually interested in investing, because many of these are looking for follow-on investments. So that'll all be included in the email. Otherwise, thank you, audience, for attending and spending an hour with us this morning, and hopefully we'll chat with you soon. Thanks, everyone.
Everyone.